Greetings, everyone. I'm here at home and in the same position you are. So we wanted to share this time with you and update you on what we believe is going on as we evolve through this crisis. So I'll be talking about the policies we're seeing and the impact we think they'll have from a macro point of view. And we'll be talking about what this period feels like compared to other crises and how we think it will play out accordingly. We'll talk a little bit about asset allocation, volatility, and finally, of course, as you might expect, we'll talk about how innovation actually gains traction and market share during periods like this one. So first on fiscal and monetary policy. As I mentioned in the piece I wrote, it's on our site at ARK-invest.com. I wrote it last week and mentioned that there have been 3 times in my career where I've seen monetary and fiscal policymakers around the world all agreeing on the same action to resolve the same problem. The first one was in 1985. The dollar had gone up 50%, and a dollar-starved world was crying out for help. And finance ministers from around the world got together, and they all decided on actions that would bring the dollar down and add dollar liquidity to the global marketplace. And it worked. In fact, we think about the 80s now and don't even really remember that there was such a crisis. That was the Plaza Accord in 1985. The 80s seem, in hindsight, to be characterized as nothing but a bull market. Of course, we did have ups and downs. We always have ups and downs in markets. The second was, of course, 08-09. Most of us remember that. Again, all policymakers around the world focused on preventing a systemic financial meltdown. And I remember saying in 2008 to my colleagues, everyone's focused on the same objective, and are we going to bet against them? And the answer to that was no, we didn't. In fact, we became more cyclical in our investment posture, and that ended up playing out very well. Of course, our main focus was on innovation, but there are ways to tilt innovation more and less cyclically. So here we are again. Policymakers around the world are focused on resolving this health crisis. That's how this started. This did not start as a financial crisis. So resolving the health crisis, which has thrown us into financial turmoil, to be sure. And we are seeing fiscal and monetary policymakers open the spigots. And they're doing it much faster than they did in 08-09 because this shock was so abrupt, and we understood how seriously it could impact the global economy by shutting it down. We've been getting a lot of questions about inflation. Do we believe that inflation is going to be a problem? Well, right now, if you look at what's going on in the short-term credit markets, you'll see that the concern is not return on capital, but return of capital. There's still a great deal of fear out there. If you look at the Volatility Index, it's up at 65, still very elevated. It had been in the mid-teens for quite a long time before this, and before peaking, actually, a little bit above 85. And on that basis, that was a closing VIX. The volatility this time around was even higher than in 08-09. So we believe right now that the liquidity that is being spewed out into the system is being absorbed. And the way we will see it manifest is further declines in the velocity of money. So that is what will prevent an inflation. We will, of course, have a lot of kindling for inflation sitting at central banks in the form of reserves. And those ultimately could be lit in the form of loans and could ultimately trigger an inflation problem. But I don't think that's what we're facing right now. We are in a period of risk aversion and fear, uncertainty, doubt. And so the last thing I think we will be worrying about right now is inflation. That's not to say it won't become a problem in the next few years, but I think it's in the next few years is the operative way of thinking about that. In terms of the fiscal policy measures that the House just passed today, I am quite gratified to see some modifications to the original proposals. And I'm influenced here by my mentor, Art Laffer, who I believe has had some influence over these policies. He was very unsettled when he started hearing about all the measures that fiscal policymakers were considering. They were basically just straight giveaways. His focus has been on the payroll tax, and he would have eliminated the payroll tax both for employers and employees through year end. Well, they didn't quite do that, but they did defer payroll taxes into next year. So trying to alleviate some of the liquidity issues that corporations and small businesses are having. So that's much better than what we were expecting. And they also included a lot of loans that will have to be paid back. And you'll note that large corporations, if they do take loans, they will have to pay back those loans and then wait a year before repurchasing any shares or including dividends, granting dividends. Now, I'm not sure in the final measure, because we haven't gotten through it all yet, if that's exactly how it played out. I'm sure there are nuances that we're not capturing here. But the fact is, these are loans, not giveaways. They're not incentives not to work. And so we think both of these actions will actually spur activity much sooner than otherwise would be the case. You can get up and running this year and defer payroll taxes, and there may be even some forgiveness in there for payroll taxes if companies maintain their payrolls and not shut down and not go bankrupt, having to start all over again. True disruption. And then for corporations, if they want to dividend out earnings or repurchase shares, they better make sure they have paid back their loans. And so that also is an incentive to accelerate activity, perhaps before might otherwise have been the case. So we do think that both of these will contribute to what I don't think many people believe will happen. But we do believe that a V-shaped recovery has a much better opportunity of happening now because of these incentives to get back to work and to work, and because of the monetary stimulus. Before this time period, we saw about 18 months where consumers, both here and in China, were doing very well, and consumption was pretty strong. At the same time, we had businesses cutting back. Purchasing managers' indexes were falling during that period. And the reason for that was businesses were fearing the impact of the China-U.S. trade conflict, and they were cutting back on inventories. They were also concerned about inverted yield curves, and they were sure, it seems, that that was a harbinger of recession, as it very often has been in post-World War II experience, but not before that time. And that's a topic for another time. But we did not believe those two were going to throw the economy off. And so we were talking about a V-shaped recovery before this crisis happened. What was happening, consumption was doing very well, and inventories were not keeping up with consumption, and capital spending was falling. So we thought that there was a rubber band stretching here, and that it would at some point turn in a very strong way. We would have a V-shaped recovery as businesses tried to catch up to consumers. Well, now we can see that, yes, there have been inventory issues. Consumption, though, is falling. So at the end of the day, we do think businesses are breaking very hard, and consumers are battening down the hatches to some extent too. We saw consumer confidence this morning come down at a faster rate than at any other time we've seen since '08, but it's still at a fairly decent level, certainly as measured by Bloomberg's Consumer Comfort Index. So if the policy measures that the government's putting through do save jobs and businesses and provide an incentive to get back to work as soon as the crisis seems to clear, and that could take several weeks to a month, in our view, then I think we're going to be looking at a V-shaped recovery. The analogy that we would use in terms of what does this market feel like? It feels like 1987, and and for more than a coincidence, 1987 was a shock. Boom! It was 25% in one day, almost 25% down in the S&P 500. Very shocking. And the reason that happened is there were a lot of investors, equity investors, who were lulled into complacency, thinking they had something called portfolio insurance, and that their portfolios would be cushioned from the severity of any sharp fall. Well, they couldn't all try and get out at the same time and have portfolio insurance work, as it turned out. And so they did suffer significant losses. The analogy today is the low vol strategies, risk parity strategies. Many of those have blown up, certainly relative to expectations, so causing, once again, a lot of fear. And so if we look back at what happened in '87, we saw that the sharp decline, and then we had a rebound, and then we bounced along the bottom and actually hit a new low in December. So the '87 shock was in October, hit a new low in December. But by that time, the new leadership had evolved, and a lot of it involved innovation, if you go back and look in history. So we would not be surprised to see the market bottoming here. The only caveat to that is I see almost every investor saying the same thing. You know, we're going to go back and test the lows. This always happens this way. And we went into this period with so much cash on the sidelines and significant risk aversion as manifest in the low vol strategies that became so popular. There were about 1.5 trillion of them, and we're sure that the risk controls that were triggered when those low vol strategies failed have washed through the system. But we do think that there will be a bottoming out period, especially because we do need to see this healthcare crisis play out, get through New York City, see how much it spreads to the rest of the country from New York, Washington, and California. I think we're doing an awful lot to prevent that in this nation. And I think the fear levels are such because of the advertisements from first China, then Italy. I think that social distancing and lots of hand washing are occurring. So hopefully we are bending the curve now. That would be great news. We do think that with bonds having done what they've done, that we're going to see a reallocation from bonds into equities. By some metrics, stocks in institutional portfolios are where they were relative to bonds in the European sovereign debt crisis, and not far above where they reached in terms of allocation in the 08-09 period. So we do think there'll be a reallocation, and it might be a much more significant reallocation this time, because it is going to be so easy to lose money in bonds, going from 80 basis points on the long-term treasury, where we are today, to say back to 3%, which, if we're right on a V-shaped recovery, should happen over the next few years. So we think that anyone who believes and sees early evidence of a V-shaped recovery is going to accelerate the allocation. We know a lot of these decisions are being made now toward the end of the quarter, but probably they will be activated during the next quarter. And I think they will serve to support stocks during the next few months. I mentioned VIX, how high it is, but I also would like to mention that this week we had three of the most powerful up days in the market in quite some time. In fact, the three together, I don't think we've seen anything like that since the 30s. And that happened with the VIX at a very high level. The VIX actually was increasing on one of the days that the stock market was going up. So we are interested in the notion that the VIX can go up during an up market. That is what happened in the late 90s. We've been wondering if when it would ever happen again. Maybe this is a glimmer of hope that we will see the VIX going up in an up market, because there is so much cash on the sideline, and there has been so much fear in the markets. And then finally, I can't end this presentation without talking about the beneficiaries in this crisis really being companies associated with innovation. And it's because these companies are problem solvers. They're going to help us get from here to there as we are working digitally, living at home, streaming more, using telemedicine, using online education, and so forth. We're also going to see a lot of companies involved in the infrastructure supporting these services. We know from using them that they could use some sprucing up, and I think that is a part of capital spending that's going to be to get a nice boost during the next year or so. We also know that mobile payments will prevent the use of cash and therefore prevent the use of virus super spreaders. I think a lot more people understand that how many germs cash has and retains for even longer periods of time than human hands, because we have enzymes that break viruses down and cash doesn't. So we also have to just give a lot of credit to the genomic revolution that's underway. We sequenced this virus in 2 days as opposed to the 5 months it took to sequence SARS. And we are now developing vaccines and antiviral medications at breakneck speed with companion diagnostics and molecular diagnostic tests helping that along. So whether it's among the 5 platforms, DNA sequencing, robotics, artificial intelligence, and blockchain technology, as well as energy storage, we think all of these are going to contribute to helping the transition to the new world. And so we thank you for listening. We're here with you. Please send us your questions. We'd be happy to answer them at any time. So thank you, and stay safe and stay healthy. And I'll look forward to speaking with you, hopefully in person very soon.